Let's get in a very important voice now. Viktor Shvets, head of Asian Equity Strategy, Macquarie, is now joining us. Viktor, thanks so much for taking out time for us. First, a view on what's happening in and around the globe. What does that mean for various emerging market countries like India and some of the others?
Whether you look at coronavirus, whether you look at geopolitical tensions, whether you look at oil prices, basically it spells less growth, less trade, less liquidity, less capital flows, wider spreads. All of that is negative for emerging markets generally and negative for India. In order to turn it into positive, you need to reverse some of those issues.
Right. Victor, I mean, we're in a very unusual situation where we've had a multi-day, multi-week sell-off, and it's only been exacerbated this morning with the crude crash as well. How does one reverse this? At this point, there doesn't seem to be any visibility on corona or really where the bottom is.
Well, when you say it's unusual sell-off, it's unusual in the recent times. There were many times when the sell-offs were quite prolonged. If you start thinking of individual elements, first you can start with coronavirus. People tend to forget that every year 3 to 5 million critical or very serious influenza cases occur globally. Up to 600,000 people die globally from influenza every year. Today, the critical cases from coronavirus is only 25,000. It is spreading, and it is unfortunately inflicting deaths. But you have to put in perspective. Just remember H1N1 swine flu in 2009 infected 20% of the U.S. population, and the death rates were about 12,000 at the time. So you need to put in perspective the coronavirus and look at the sort of numbers as they're coming through rather than panicking the way a lot of people seem to be doing these days. Number two, how do you reverse some of the elements? Very similar, in my view, to 2008. If you remember, in 2008, there was a Ministry of Finance meeting in Washington, which was followed by G20 in 2009 in London. What it created is a globally coordinated policy response. What it was, cuts in rates, lots of liquidity, substantial increase in fiscal spending. Today, some of that fiscal spending really needs to go into treatment in hospitals rather than infrastructure. But those were coordinated responses. Today, it's much harder to get coordination because most countries are now run by nationalists of various colors. And it's much, much harder to get that coordination. But that's what you need. And finally, I do think you need to clarify the role that Russia is going to play in global affairs. Russia has been severely isolated on the global scene. It basically was cut off and has been cut off for quite a number of years from global markets and global finance. One needs to redefine what will be the role of Russia as we go forward. So these are some of the concrete things you can do.
Victor, when we just look at the way some of these asset prices are falling, what does this essentially mean when crude falls so much? What does it mean for growth? What does it mean for emerging markets? What does it mean for investor sentiments in terms of foreign equity flows?
Well, first of all, it's deflationary. All the things that central banks have been striving to achieve, and that is avoid deflation, actually is brought forward. Oil price is basically tax on consumers. It's tax on businesses. Only very few countries benefit from rising oil prices. But when an oil price falls too far, it just becomes deflationary. What you need to find is an optimum number rather than too high or too low. So what it means for emerging markets and what it means for developed markets, yes, you get a little bit more consumption. Yes, the tax rate is less on the consumers and businesses, but the overall environment becomes deflationary, which means corporates have difficulty increasing prices, labor has greater difficulty increasing wages. Now, the impact, of course, varies from countries to country. It's much more severe in areas that rely on oil prices. In the case of India, India really cannot tolerate when the oil prices are too high. but neither can India tolerate when the oil prices are too low. India really needs a Goldilocks. So net for EMs, less growth, less reflation, greater pressure in the high yield markets, higher spreads. Net, very low oil prices are negative for EMs, not positive.
Would you buy into this fall into emerging markets? What would be your top country picks?
Well, it's like catching the knives, right? We've got so many elements changing right now and so many elements impacting. The key question I think the investors have to ask themselves, is it too late to be defensive? Places like and industries like staples, for example, or anything defensive, has outperformed global indexes by at least 500-600 basis points, and that's just in the last 2 weeks. On the other hand, if you think of a lot of cyclicals and value, they've been down anywhere from 500 to 1,000 basis points relative to their respective indexes. And so if you look at it, the question is, do you think that some degree of coordination will be there? Do you think market is sending message to regulators, to policymakers, to countries? Either you coordinate or you die. If the answer we die, then yes, purely defensive is a way to go forward. It's your local, it's your staples, it's US dollar, it's gold, it's safety. That's all you're going to be buying. Everything else will go away, including emerging markets, including trade, including growth. Now, if on the other hand you were to argue that I do not believe anybody will accept that outcome, then it could be a time to start looking at some of these stocks that people were throwing out completely, and that includes a lot of value and a lot of cyclical stocks. So it's really a binary decision that one needs to make.
Victor, if you could elaborate on that at a time like this, given that we're seeing a selling frenzy across the globe, what within cyclicals do you think is deriving comfort at a time like this?
Well, cyclicals generally in value don't derive comfort from pandemics. They don't derive comfort from less growth. They don't derive comfort from deflation. And so whether you look at materials, whether you look at energy, whether you look at financials, all of those cyclical and value areas need more liquidity. They need more inflation. They need more growth. And so if you don't get it, they can become very, very cheap, very cheap. You have to remember that 10, 15% drop sounds a lot, but at certain periods, some of those companies were falling 60, 80, 90%. So it comes down to if you want to buy oil company, if you want to buy material, if you want to buy infrastructure companies, if you want to buy banks and financials, the question is, do you think there will be a globally coordinated approach, or do you think it won't be? Do you think coronavirus will mutate into another Spanish flu? Or do you think it's more like a very bad influenza that will be more or less contained at a level not dissimilar what happened in the past? Depending on the answer to those questions, you wouldn't touch any cyclicals value, or indeed you go the other way and start saying now is perhaps not the time to be buying staples or to be buying defensives.
Given that this is coming off a very steep high in terms of where the markets were, all-time records, in terms of valuations, in terms of flows, is this going to have a longer-lasting, damaging effect on sentiment, according to you? I mean, even if we do see a calibrated attempt by the central bankers from around the world, or do you still see markets being sensitive to any kind of approach they may take?
I think just like in 2008, there is a period of recuperation that is needed. And also remember, regulators and governments do not move immediately. Neither do they move usually in coordinated fashion. Remember, TARP program in the United States did not occur until Lehman Brothers bankruptcy, even though it was discussed and debated. Only when Lehman Brothers bankruptcy occurred did the Congress almost immediately approve the TARP program to support U.S. industries. The same applies to almost all countries, whether it's ECB trying to get a handle of what to do with Italy when substantial part of the country is shut down, whether it's China's decisions, how they navigated the last 2 months. It's very hard to come to a coordinated approach, particularly now. And so the question is, do you need a Lehman Brothers type of bankruptcy? Do you need a major explosion in a high yield market, for example, to crystallize everybody's minds? Or do you have to have pestilence becoming much more virulent for everybody to coalesce? So that's a dilemma, I think, that the investors are facing. Just like 08, 09, there is a period of recuperation, and there is a period when the sentiment is badly damaged. I think that will be the case for quite a number of quarters through 2019, maybe into 2020, maybe into 2021 quite easily. But at the end of the day, I do think people will have to coalesce because the choice is, as I said, you either destroy the economic system based on assets and based on debt and liquidity, and you reset the entire global economy and markets, or you try to save it in some form.
The last word on the central banks and what essentially they will do. Don't you think from 2008-9 till now they have become much more preemptive? They have started to cut rates or announce asset purchases much before they sense any crisis?
Yes, they have. But one of the things which is different to 2008 is that they also become much more nationally oriented. In other words, the degree of pressure that national governments are now exercising over their central banks, whether it's Thailand, whether it's Turkey, whether it's India, whether it's U.S., is far greater. In other words, the central bank independence or perception of independence in 2008 was much higher than what it is today. And that's part of the reason when you elect nationalists, that's what you get, that central bank independence erodes. So to answer your question, yes, they respond faster, but because they're much more locally oriented, it's much harder for them to pull together because they don't view things quite in the same way.
Thank you for your time, Viktor. Appreciate you joining in and giving us a sense as to how investors should be approaching this massive crash that we're seeing in equities as well as across other asset classes.